Welcome to the Property Wealth Podcast, where we dive into practical and relatable real estate investing advice. If you're over 40 and looking to build long-term wealth, you're in the right place.
Absolutely. Today, we're going to explore a topic that's really buzzing right now. Where to find undervalued markets in 2026.
It's such an exciting time for real estate, and with the right insights, you can really make your investments work for you.
Exactly. We'll cover some key strategies for identifying those hidden gems in the market. And of course, we'll share some tips on how to evaluate these areas effectively.
And don't forget, we'll also touch on how to balance risk and opportunity, so you feel confident in your decisions.
Yeah, that's a big one. You want to feel secure and informed as you navigate these choices.
So whether you're thinking about expanding your portfolio or just starting out, there's something here for everyone.
Right. Let's jump right in, shall we?
Definitely. Let's start by discussing what makes a market undervalued in the first place. What should listeners be looking for?
So, Sarah, why does finding undervalued markets matter so much, especially for folks over 40 right now?
Well, I think it really comes down to timing, right? People in that age group are often starting to think about retirement, and the clock is ticking.
Absolutely. And with inflation being such a hot topic these days, it's affecting everything from groceries to gas. We've got to be strategic about our investments.
Right. If you're relying solely on traditional retirement accounts, you might not be keeping pace with inflation. That's where real estate can really shine, especially if you find those undervalued markets.
Exactly. I've seen investors who were in their 40s and 50s, just like our listeners, who took a leap into less popular areas, and they've seen their property values double or even triple in just a few years.
Yeah, like the story of that couple we talked about last week. They bought in a smaller town that was kind of off the radar.
Right. They did their homework, found a location that was undervalued, but had great potential due to a new tech hub moving in.
And now they're not just sitting on a property. They're building real wealth for their retirement.
Exactly. And that's the thing. It's not just about the numbers. It's about the emotional security that comes along with it.
Oh, totally. Knowing that you have a solid investment can really ease those fears about financial stability later in life.
And for many, it's about legacy too, thinking about passing on wealth to family.
Yes! I chatted with a woman last week who said she wanted to ensure her kids had something meaningful to inherit.
That's such a powerful motivator. Real estate can provide that tangible asset that appreciates over time.
And let's not forget about the current economic trends. With so many shifts in the market, being ahead of the curve can really benefit those looking to invest.
Right. For instance, as cities expand and populations grow, some areas get overlooked.
Exactly. Like, I read about a neighborhood that was once considered up and coming, but was undervalued for years, until suddenly it wasn't.
Yeah, and it's those moments that can make all the difference. It's about being in the right place at the right time.
And having the right mindset, too. Some investors get too caught up in what's popular now, instead of looking for those hidden gems.
Totally. I've met investors who only look at trendy neighborhoods, but those can be super competitive and pricey.
And often not worth it in the long run. I think it's crucial for our listeners to realize that there are opportunities in the less glamorous areas.
Definitely. And they don't have to dive in head first. They can start small, test the waters, and grow their portfolio gradually.
Oh, for sure. It's all about building confidence.
Right. And let's be real. It can feel overwhelming to think about investing later in life, but it doesn't have to be.
Exactly, Mike. It's about making informed decisions. And that can really set you up for success.
And speaking of success, I remember working with a client who was in his late 50s. He was really unsure about where to invest.
What did he end up doing?
He took a leap and invested in a small multifamily property in an area that was just starting to see revitalization.
That's exciting.
It really was. And now, just a few years later, he's not only seeing great returns, but also has tenants who are happy living there, which creates a sense of community.
So it's not just about the financial aspect. It's about being part of something bigger.
Exactly. And for someone over 40, that can be really fulfilling. Knowing your investment is helping to uplift a community.
And speaking of community, we should talk about how to actually identify these undervalued markets.
For sure. And it starts with understanding the local economy, looking for signs of growth like new businesses moving in, infrastructure improvements,
Yeah, and even checking out the local schools. Good education can drive up property values in the long run.
Definitely. And let's not forget about demographics. Are younger families moving in, or is there an influx of professionals?
Right. All these factors create a picture of potential growth.
Exactly. And I think we should also touch on how to leverage online tools and resources to do this research.
Oh, for sure. There are so many platforms now that can help identify trends and market shifts.
And if you combine that data with local insights, it really enhances your understanding of a market.
Definitely, Mike. So listeners, as we dive into these strategies, keep in mind how finding undervalued markets can not only help you build wealth, but also offer that peace of mind as you approach retirement.
Right, and it's all about being proactive rather than reactive in today's market. Let's get into those core strategies. So let's dive into some of those core strategies. When you're looking for undervalued markets, one rule of thumb that I find really helpful is the 1% rule.
Oh, I've heard of that. Can you break it down a bit?
Sure. The 1% rule suggests that the monthly rent you can collect should be at least 1% of the purchase price of the property. So if you're buying a property for, say, $200,000, you should aim to rent it out for at least $2,000 a month.
That makes sense. So if you find a property that doesn't meet that 1% threshold, it might not be a good investment, right?
Exactly. It's a quick way to filter out properties that just won't cash flow. But it's not the only metric you should consider.
What's another one?
Well, there's the 50% rule, which is basically a guideline for estimating your operating expenses. The rule suggests that about 50% of your rental income will go toward expenses, things like property management, maintenance, taxes, and insurance.
So if you're expecting to make $2,000 a month in rent, you'd want to budget about $1,000 for expenses?
Right. And that would leave you with a potential cash flow of $1,000. But remember, this is just a guideline. Actual expenses can vary, so it's always good to do a deeper dive into each property's specific costs.
That's a good point. What about the cap rate? I hear that term thrown around a lot.
The capitalization rate, or cap rate, is another crucial metric. It's calculated by taking the net operating income NOI of a property and dividing it by the property's purchase price.
So let's say a property generates $24,000 a year in rent, and after expenses, you're left with an NOI of $12,000. If you bought the property for $200,000, what's the cap rate?
You divide $12,000 by $200,000, which gives you a cap rate of 6%.
Got it. So a higher cap rate usually indicates a better return, right?
Exactly, but context matters. A good cap rate can vary by market. In some areas, a 6% cap rate might be excellent, while in more expensive markets, it might not be enough to justify the investment.
So it's all about understanding the market you're in. Are there other metrics that investors should keep in mind?
Definitely. You might also want to consider things like cash-on-cash return, which looks at the cash flow you're generating relative to the cash you've invested. It's particularly useful if you're using financing to purchase properties.
Can you give me an example of that?
Sure. Let's say you buy a property for $250,000 and you put down $50,000 as a down payment. If your cash flow after expenses is $3,000 a year, your cash-on-cash return would be $3,000 divided by your $50,000 investment, which is a 6% return.
And that helps you understand how your cash is working for you?
Exactly. And it's also crucial to think about the type of property you're investing in. Single-family homes, multifamily units, or commercial properties all come with their own sets of risks and rewards.
Right. What do you think are some of the pros and cons of these different property types?
Well, single-family homes are often easier to manage and finance, plus they're always in demand. But the cash flow can be less predictable. Multifamily units can provide better cash flow, but they come with more management responsibilities. Commercial properties can offer higher returns, but they're also more volatile and sensitive to market changes.
It really depends on what you're comfortable with, doesn't it?
Absolutely, and that's why I always recommend doing a thorough deal evaluation checklist.
What should be on that checklist?
You want to start with things like the purchase price, estimated rental income, and all the expenses we talked about. Then, assess the neighborhood. Look at job growth, schools, amenities, and crime rates.
So all those local factors really play into the overall investment strategy?
For sure. And don't forget to look at the potential for appreciation. Are there developments or infrastructure projects planned in the area? That could really boost property values over time.
That's a great point. It's about looking at both the present and future potential, isn't it?
Exactly. And speaking of future potential, financing options can also play a big role in your overall strategy.
What are some options investors should consider?
Traditional bank loans are common, of course, but there are also options like FHA loans for lower down payments, or even hard money loans for quicker access to cash.
And what about private investors?
Absolutely. Partnering with private investors can be a great way to leverage other people's money, especially if you have a solid plan and can show them the potential returns.
So it really comes down to knowing your numbers and understanding your financing options?
Exactly. But keep in mind that even with all this planning, there are common pitfalls to watch out for.
Like what?
Well, underestimating expenses is a big one. Many new investors forget to account for things like vacancy rates and maintenance costs.
That's so true. And I bet emotional decision-making can be another pitfall.
Definitely. It's easy to get attached to a property, but you have to stick to your investment criteria and not let emotions cloud your judgment.
That's such good advice. I think having a solid strategy in place can really help mitigate those risks.
Absolutely. And being patient and doing your homework will pay off in the long run. Well, I think that covers a lot of ground on where to find undervalued markets and how to evaluate deals effectively.
It really does. Thank you for sharing all this valuable insight, Mike.
You know, Sarah, when we talk about finding undervalued markets, there's definitely a lot of excitement around it. But there are also some common pitfalls that investors can fall into.
Absolutely, Mike. I think one of the biggest mistakes is over-leveraging. It's like you get so excited about a potential investment that you stretch your finances too thin, right?
Exactly. I've seen it happen more times than I can count. A friend of mine, let's call him Dave, got caught up in the hype of a hot market. He took out a massive loan to invest in multiple properties all at once, thinking he'd cash in big. But when the market shifted, he found himself unable to cover the mortgage payments.
That sounds really stressful. So what happened next?
Well, he had to sell one of the properties at a loss just to make ends meet. It was a tough lesson for him, and it really emphasized the importance of evaluating your financial limits before diving in.
Definitely. And I think that leads us to another pitfall: bad tenants. It's one thing to find a great property, but if you end up with tenants who don't pay or, worse, damage the place, that can turn into a nightmare quickly.
Right, and I remember another investor, let's call her Lisa, who thought she'd scored a great deal on a rental property. She was so focused on the purchase price that she didn't really vet her tenants.
Oh no, what happened?
Well, they were late on rent every month, and eventually, they just stopped paying altogether. She ended up having to go through the eviction process, which is not only costly, but incredibly time-consuming.
That must have taken a toll on her finances and peace of mind.
It really did. It's crucial to do your due diligence, check references, and consider using a property management service if you can. Sometimes, it's worth paying a bit more upfront to avoid those headaches down the line.
Speaking of headaches, another common mistake is ignoring cash flow. I think some investors get so caught up in the long-term appreciation that they forget the day-to-day expenses.
Exactly. A colleague of mine, let's call him Tom, bought a property he thought would appreciate rapidly. He didn't factor in property taxes, maintenance, and management fees, and he ended up in the red every month.
Yikes! So he was essentially paying out of pocket to own that property?
Precisely. He was so focused on what he thought the property would be worth in a few years that he neglected the cash flow aspect. It's essential to have a clear picture of your income versus expenses.
That's a great point. And I think many people also fall into the trap of trying to time the market. You know, waiting for the perfect moment to buy.
Absolutely. Timing the market is like trying to predict the weather. A friend of mine, let's call him Mark, tried to wait for a dip in prices. He kept saying, I'll wait for it to drop. But guess what? Prices just kept climbing.
So he missed out on a lot of opportunities?
Exactly. By the time he decided to jump in, he was paying a premium and he lost out on a lot of potential gains. It's better to invest consistently over time rather than waiting for that perfect moment.
That makes so much sense. And then there are those hidden costs that can catch investors off guard, right?
Oh, for sure. One of the biggest red flags I see is when investors don't account for those unexpected expenses. For example, I knew an investor, let's call her Karen, who bought a fixer-upper. She thought, I'll just put in a little work and it'll be great.
Sounds reasonable on the surface.
Yeah, but she didn't budget for the full extent of the repairs. When she got into it, she found mold, plumbing issues, and electrical problems that weren't visible at first. Her renovation costs skyrocketed.
Wow, that must have been a huge setback for her.
It really was. The key takeaway here is to always get a thorough inspection and budget for contingencies. It's better to be prepared than to be surprised.
Great advice. So if someone is listening and they recognize they might be falling into one of these pitfalls, what can they do to recover or avoid these mistakes?
Well, first off, I'd say take a step back and reassess your financial situation. Understand what you can truly afford.
And definitely do your research on potential tenants, right?
Exactly. Spend time vetting tenants, and if needed, consider hiring a property manager to help you.
And what about cash flow?
Always keep a close eye on your cash flow. Make sure your income covers your expenses and have a buffer for unexpected costs.
That's so important. And when it comes to timing the market, it's really about focusing on a long-term strategy rather than trying to predict short-term fluctuations.
Exactly. And regarding hidden costs, thorough inspections and budgeting for repairs can save you a lot of headaches later on.
So it sounds like being proactive and informed can really make a difference.
Absolutely. Knowledge is power in real estate investing. If you can spot these red flags early, you can make smarter decisions and build a more sustainable portfolio.
Great insights, Mike. Thanks for sharing these real-life lessons. I think our listeners will find this really helpful as they navigate their own investment journeys.
My pleasure, Sarah. It's all about learning and growing in this business. You know, Sarah, when it comes to finding those undervalued markets, I think the first step is really about getting familiar with the data out there.
Absolutely, Mike. One of the best tools I recommend is Zillow. It's pretty straightforward, and you can filter properties based on price, location, and even historical data.
Right. And you can look at trends over time, which is key. It gives you a sense of whether a market is on the rise or potentially undervalued.
And don't forget about Bigger Pockets. Their calculator can be a game changer for analyzing potential deals. You can plug in your numbers and see if it makes sense.
For sure, and it's great that they also offer a community where you can ask questions, share insights, and learn from others. Networking is so important in this business.
Speaking of networking, I think joining a local real estate meetup can really accelerate your learning. You can connect with experienced investors and get a feel for the local market dynamics.
Yes, and those meetups often have guest speakers who share their experiences, which can be really insightful. Plus, you might find potential partners.
Totally. And let's not overlook the value of Rentometer. It's a simple tool to check rental rates in a specific area, helping you gauge if a market is worth exploring.
Exactly. Understanding the rental landscape is crucial, especially if you're looking to invest for cash flow.
And if you have access to your local MLS, that's a goldmine of information. You can see what properties are actually selling for, not just the listed prices.
Right, and the MLS usually provides detailed insights into the neighborhood, which can help you spot trends before they become obvious.
So what about books or podcasts? Are there any that have really influenced your approach to real estate investing?
Oh, definitely. I recommend The Book on Rental Property Investing by Brandon Turner. It's packed with practical advice and real-world examples.
That's a great one. I also love Real Estate Investing for Dummies. It breaks everything down so simply, which is perfect for newcomers.
And on the podcast front, Bigger Pockets podcast is a must-listen. They cover a wide range of topics and feature investors from all walks of life.
Yeah, I find those personal stories really inspiring. They help listeners see that, anyone can start from scratch and build wealth through real estate.
Exactly. And if someone wants to start small, I'd suggest analyzing one deal a week. Just pick a property, run the numbers, and see if it's a good fit.
That feels manageable, right? And it builds your confidence over time. You'll start to recognize patterns and feel more comfortable making decisions.
Plus, setting a goal to analyze one deal a week keeps you engaged and focused on the market. It's all about building that habit.
And don't forget about social media. Following local real estate groups on platforms like Facebook or LinkedIn can provide valuable insights and networking opportunities.
Absolutely. Engaging with those communities can keep you updated on what's happening in your area, and you might discover hidden gems.
And speaking of gems, consider researching emerging neighborhoods. Look for areas with new developments or infrastructure improvements.
Yes, those are often indicators of growth. Just keep an eye on where people are moving and what amenities are being added.
And remember, it's okay to start where you are. You don't need a ton of money or experience to begin your journey. Just take those small steps.
Right. And as you gain knowledge, you can scale your investments. Just stay curious and keep learning.
So those are some practical first steps. Now let's bring this all together.
All right, Sarah. As we wrap up, let's highlight some key takeaways from our chat on finding undervalued markets in 2026.
Yeah, absolutely. One big point we discussed was the importance of looking at local economic indicators, right? Like job growth and population trends can really signal where to invest.
Exactly. And don't forget about the power of networking. Connecting with local real estate agents can give you that insider knowledge on emerging markets.
Right, and we also touched on the significance of understanding neighborhood dynamics, like what's happening in the community can really affect property values.
For sure. And then we mentioned the value of being adaptable. Markets change, so being open to new strategies can really set you apart.
Yes, and let's not overlook the potential of technology. Tools like data analytics can help you spot those hidden gems in real estate.
Well, it all comes down to being proactive and informed. Building wealth through real estate is a journey. And, it's about making smart choices over time.
Absolutely. If you're over 40 and thinking about investing, remember, it's never too late to start.
Right. And speaking of starting, if you enjoyed today's discussion, please like this episode, subscribe to the channel, and share your biggest takeaway or any questions in the comments.
And don't forget to share this with someone else over 40 who's interested in property investment. They might find it really helpful.
Next time, we'll be diving into how to turn your primary home into a rental.
That's going to be a great one.
Definitely. Thanks for joining us today.
Yes, thank you all. We appreciate you tuning in, and we can't wait to see you next time.